I'd like to give a very warm welcome to our today's panel moderator, Abood Shabalut, who's the founder and CEO of Diagnos. And Abood, the stage is all yours.
Thank you, Mohsen. Thank you, Karandeep. I'll just introduce myself really quickly. I'm the CEO and founder of Diagnos, which is an AI company focused on making the work of doctors more effortless and effective. Our digital sidebar assistant follows doctors around from patient to patient and helps them with various tasks. And our marquee AI tool reads doctors' notes in real time and automates the diagnosis documentation process for them. This isn't my first rodeo in the healthcare space. Prior to Diagnos, I launched and managed a business that litigated insurance companies for unpaid medical bills. I've also launched and managed a clinic and pharmacy where I learned most of what I know today about the challenges of healthcare operations and healthcare revenue cycle management. Thank you, everybody, for tuning in today. And I'm excited to be moderating this panel. In fact, we have an amazing panel of VCs. And in this conversation, we'll be discussing the present recessionary environment and how it's impacting the tech world. We'll cover things like investment, deal flow, and portfolio management thoughts, and much more than that. And with that, I'm going to ask the panel to introduce themselves, and we can start with Jennifer.
Thank you. Hi, everyone. I'm Jennifer. I'm a partner with Edison Partners. For those of you who are not familiar with the firm, Edison Partners, we are a growth equity firm, and we're investing actively across fintech, healthcare, IT, as well as enterprise software. Regardless of the industry vertical, fundamentally, we're tech investors. My role as a partner, of course, I lead our fintech investments here, so that happens to be my focus, as well as serving on boards post-investment all the way fully through exit. So that's a little bit about me.
Thank you, Jennifer. Doran, do you want to introduce yourself?
Hello, everybody. My name is Doran York. I'm the founder and CEO of Cityside Ventures here in Birmingham, Michigan. We are an early stage investor. We're managing 3 different funds from pre-seed to Series A. We invest in scalable tech companies, primarily in the US, a little bit in Europe, and in Israel a lot. We built a portfolio of close to 120 companies in the last 2.5 years. I'm glad to be here.
Thank you, Doran. Sheila, would you like to introduce yourself?
Sure. Hi, everyone. I'm Shyla Nieves Burney. I am the founder and managing partner for Zane Venture Fund. We are an early stage venture fund based here in Atlanta. We are raising our first fund, targeting a $25 million fund to invest in diverse founders and teams who are building tech-enabled solutions primarily here in the Southeast and opportunistically across the US. We've made 5 investments last year, and we're looking to make 5 more this year. So really happy to be here and meet the entrepreneurs, or talk to the entrepreneurs in your community.
Awesome. And last but not least, Daniel.
Hi, thanks so much for having me. My name's Dan Epstein. I'm a director at Trust Ventures. Trust Ventures is a fund that focuses on early stage startups, where we are primarily looking for startups that are distressed in terms of regulatory risk and regulatory barriers. And what we do is we invest in those companies and help them overcome those barriers to achieve long-term growth.
Super interesting. Thank you, everybody, for introducing yourselves. I'll just jump right into it and kickstart the conversation. My first question is, what do you make of the COVID economy today, and how is it affecting the way that you pick portfolio companies moving forward? If anyone wants to volunteer with an answer, we can start the conversation that way, or I can just pick on somebody. Totally up to you.
Okay, I can start. Maybe it's because they picked on me at school a lot. Anyhow, I think for the most part, for us, we just had discussion about it yesterday. For us as early stage investors, most of the companies we're investing in, probably 60% of them, 50 to 60% are pre-revenue. So I don't think the economy or the COVID situation have a big impact on those companies. They're not in the market yet. But from the other side of it, in terms of picking companies you're looking at, we identify 6 or 7 sectors in the market that we believe going to take much longer to recover after the pandemic is subside, and trying not to pick companies in those particular industries right now. The industry will have to kind of recover before they allow more spending. But there's a lot of other opportunity in tech that the pandemic opened the door for a lot of tech companies to come and offer. So all in all, we think that pandemic or COVID, in terms of our ability to select and invest in companies, in the midst of the pandemic in 2020, which everything kind of stopped for everybody, our group did 37 deals that year. So I don't think anything stops. I think, like I said, most of the companies that we invest in are too early to be concerned about the economy. And they have at least taken 2 or 3 years to get into the market and scale. So we didn't see a significant impact from that perspective.
That makes a lot of sense. Yeah, go ahead, Daniel.
Some views that I think are in many ways consistent, but different. And so, we as a fund have kind of observed 2 things. One is more kind of a empirical observation, and then one is from kind of a regulatory perspective. So as an empirical observation, we view kind of COVID as an exogenous shock to global markets in terms of actually forcing certain preferences by consumers to actually be revealed and measured in a much more effective way. So certainly we have seen growth in telemedicine startups, growth in startups where you can get home-based services, anything that relates to the idea of being able to work from home, educate from home, get groceries delivered to one's home. All of those sorts of things have turned out to us to be very good businesses, in large part because there are either changes in consumer preferences, or we're now able to kind of pick up on something about consumer preferences that previously was not fully transparent. And what I'd say on that, that I think we believe has long-term effects even beyond the pandemic, is a lot of the best startups you've seen that have really kind of launched their major Series B, Series C, or growth rounds during the pandemic and have become unicorns. What I think is a universal rule that we've identified is that a lot of these companies are providing products or services that historically were viewed as having secondary or tertiary uses. In other words, no independent primary use. So let me be specific. A company like Notarize, which does remote notary services, the assumption was always that you only became a licensed notary if you were a banker or a lawyer. You had some other primary job, and the notary was the side gig. Well, a lot of innovators during COVID have realized that we can make secondary products or uses primary products and services. And I think that's something that's going to last past the pandemic. In terms of what we've observed from a regulatory perspective, I think this is a lot more obvious, which is that whether it's because state governors have declared states of emergency or otherwise, there have been a lot of the effect of almost a regulatory sandbox where certain kinds of companies that normally require licensure, otherwise might be subject to enforcement or rulemaking, all of a sudden are able to scale because of emergency type exceptions in the law.
Just one follow-up question for you, Daniel, before we move on to Shyla and Jennifer. Would you say that the COVID economy has enabled you to take more risk in terms of these startups that historically faced regulatory obstacles?
Yeah, absolutely. We're becoming a lot more bullish companies that are doing things that in many ways are possible now because of exceptions under COVID. And we think that our bet is that once the emergency ends and the regulations start being enforced, that we're going to have success in showing proof of concept that the laws need to change.
Very interesting. Shyla, would love to hear your thoughts on the COVID economy and how it's affecting how you pick portfolio companies moving forward.
Sure. So I think the one thing, and I'm going to just piggyback on some of what Daniel was saying in terms of the different sectors that we are looking closer at now, and that's ed tech, fintech, and digital media and digital health. And some of these were not, industries we were looking at or sectors we were looking at before COVID. And now we are like honing in on those companies because we feel like those are the companies, in my opinion, are going to sort of rise to the top post-COVID. Well, I mean, post-pandemic, if we ever get to that point. And so those are the companies that we're looking for. We will look at just about any tech-enabled company, but we are really focused on those particular companies that are providing those types of resources and services that we won't be able to do without them, right? And so kids can't go to school if there's no sort of online presence for them right now. So those kind of sectors have become incredibly important for us. And so we're looking for, in terms of our founders or our portfolios, our companies are doing extremely well in a pandemic. And I think that was because they focused on the customer and what the customer wanted. And yes, they're pre-revenue, but it has caused them to find that their customers want different things. And so being able to pivot in that in the midst of a pandemic is what I'm looking for, those founders who have been able to do that. And so far we found some who have. And so that's kind of what's impacted our outlook on entrepreneurs.
Very interesting, especially that point that you made is that, sometimes, or actually all the time, the startup is able to pivot, right? Especially if you're nimble and young enough, and that allows much more customer focused building in terms of technology roadmaps. Very interesting. Thank you, Shyla. Jennifer?
Yeah, sure. Not to repeat some of the things that's already been said, and coming from more of a kind of growth equity perspective, we do obviously invest in companies with proven traction. Things like unit economics and all these things become important. I think Doran said earlier, just in terms of areas that maybe shied away from by investors. What's common though, especially if you're a tech investor, regardless of the industry, there are certain trends that absolutely accelerated in terms of adoption. Digital isn't going anywhere. Value proposition, the core value proposition of delivering products inexpensively, digital first, on demand, transparency, you name it, all those things. If you have those as a foundation, regardless of areas, and to be fair, some areas did get impacted a lot more negatively and some areas a lot more positively throughout the last 2 years, those things won't go away. Now, then the thing is, how do you think about what that would be in 5 years from now? What does that mean 5 years from now? What does that mean in the long run? What does that mean, going forward? Is this a temporary, either negative or positive impact? Is this, lasting sort of, this is how the world has fundamentally changed sort of mentality, right? So navigating through all that, because I think there's been lots of conversations around the COVID and impact of various different things over the last 2 years too, just in the industry overall. I think now, and maybe this is kind of forcing the conversation into the next topic, possibly, if this was indeed a next topic, but I think now coming into 2022, there's other things that people are talking about, right? Anywhere from labor, that, certain labor trends that hasn't gotten, that's gotten to a certain degree, all the way to inflation, all the way to, of course, the volatility in the public markets, all the way to, I think, what you initially started this whole panel with, the comment around kind of recessionary period type, right? Because now it's not just about COVID anymore. There's a lot more other factors that happened and built up over the last 2 years that's kind of leading to certain things now, where a lot of conversations been focused on, right? And that by default, a lot of companies are looking at, especially growth tech businesses, private companies too, really focusing on, the fundamentals in terms of unit economics that always did matter. Don't get me wrong, in, bull or bear markets. but really understanding how do you get, higher LTV and lower CACs all the way to how do you get to XYZ in certain areas while thinking about, can you get profitable if you wanted to, type of mentality in these growth sort of businesses, right? That's a really long-winded way of not only cramming about 10 different topics into what I just said, but also, it's all related to a certain degree. But let me pause there since I've kind of monologued for a bit.
No, it's great points, and definitely, everyone should feel free to kind of steer this conversation in a natural way, in an organic fashion. So this is definitely a great segue into some other aspects of this conversation. But I have to ask, do you like, and this may or may not be an elephant in the room, but do you view us in 2022 as moving into a bear market, or do you still look at the economy in a very bullish manner when it comes to the investments that you're making?
It's a really interesting question. I think that question last year was flipped, and it was, are you concerned about how high things are? And now, are you concerned about how low things are? So one, private markets, to be clear, there's about 6 months of catch up between private and public markets, just in terms of what happens between, and we can kind of pull on all kinds of different threads there. But what I was talking about earlier in terms of fundamental shifts, that was never overnight, by the way. It got accelerated through COVID because of various different, whether it be because of the lockdown and you had to go digital or whatever it may be. There are certain things that accelerated. None of these were overnight either, but innovation and digital first, all the core fundamentals that is applicable to every single person in every single industry will always be there, and that'll continue, right? And from a private market perspective, and as an investor, you think long-term. You're not thinking, what the share price is going to do today or tomorrow. This is all kind of long-term considerations that all of us on this panel always have to think through, right? So that's a way of answering your question in terms of bull or bear market, because for us, it's about, regardless of the market, do you have the right fundamentals? Do you have the right, basics for you to continue growing, continue really expanding, continue, in various different ways, even in pivot in some cases, like Shaila was talking about early on, right? How do you continue to adapt in whatever new normal it may be into the next stage of your business? That will never change. We have, of course, as an entire economy and, country, we've gone through multiple, booms and busts in the past, right? If you look at historically, how do you make a company and your value prop that's going to last through different cycles? That conversation, I think everybody, frankly, has had in their mind over the last 2 years because of the very sudden shutdown in March 2020, really triggering a lot of these fears back then too, right? Daniel, I see you unmuted. Please jump in.
Yeah, I really wanted to follow up on what Jennifer was saying, because one thing that I think is certainly true and that we've seen with a lot of our portfolio companies is that, and I think this is due to kind of the points Jennifer made about, if you weren't digital native before, you were quickly becoming digital native as a consumer. And what I think that means from the business standpoint is, if you started as a workforce marketplace company in a specific industry, you now have to know something about digital payments, because your workers their preferences regarding that are also changing. And just like if you're a kind of payment company, you might have to start thinking about, to remain competitive, how do we provide certain kind of remote services? How do we connect our kind of workers or our stakeholders to special, digital or financial products that allow for rebates and benefits? And so what it has led to is, I certainly think there is an advantage in the market to those businesses that can get their core products to also be complementary to other kinds of technological developments. And I think probably before COVID, you had some runway with a core product in terms of growing within the market. Now, I think the trends in which you're seeing startups raising more quickly at much higher valuations is showing that the prize money is going to those executives, those founders who can really kind of build out their core product at the same time that they're launching complementary products.
And I want to give an example, speaking of founders and that pivot, I'll give an example of one that did and is doing incredibly well. So this was basically our first investment we made last year into a company that was hardware. And you're talking about like crises, and then she had a chip that she needed to put into the device. And the supply chain was just, of course, you all know that we're having so many issues with supply chain. But she was so smart to pivot to software, to Daniel's point about finding other customers or finding other ways. She pivoted to software and her customers, because everybody was in the kitchen cooking. So let me just explain the company. She has a smart knob that you retrofit over any smart stove, and it becomes a smart stove. And so you're able to turn your stove on and off with your smart device, cook away from home, that sort of stuff. And so, but the device itself, the only chip maker is in Taiwan, I believe. And so she had to decide quickly, so what am I going to do? We're waiting for this chip. Then I have customers who had like 1 million orders already. And so she decided, I'm going to pivot to software. Everybody's cooking. Everyone's looking for recipes or whatever. So it was complementary to her product, which is a smart knob. Now she had to do a bridge round to be able to keep up with demand from these customers who are now more interested right now in her software. And so I think it's incredibly, like, founders have to see beyond what's happening right now and think up ahead. And to your point about being in a whole nother area you didn't even think yourself you were going to be in, being a digital native or being a digital, now you got to create these things to keep up with customer demand. And so I think for those who think smart enough, as soon as they see a problem starting to happen, those are the ones who are going to be able to do well post-pandemic, post-COVID, in my opinion.
Well, just to
Very
add
cool.
to what everybody else is saying, Jennifer and Daniel, I had the privilege to be in a conference 2 days ago with the CEO of GM, Mary Barra. And Mary basically said, the pandemic accelerated the whole process. It didn't create any problem. And she said, before we used to think we drive the change, now we're chasing it. So all the companies basically challenged right now, especially in automotive, we're in Detroit. So she said, we're chasing the change. And she announced pretty publicly that GM is no more automotive maker, it's a software company. So basically to say that most of the Fortune 500 companies become an IT company if they like it or not, which create a lot more opportunity. So if you're looking at it from the financial side or you're looking at it from the evolution side, from the financial side, as early stage investor, depending who you ask, right? I don't know what stage Jennifer invests or Sheila, but we invest very early. So for us, we're going to double down our investment this year. We're going to do a lot more we're planning to do because the VC is sitting on an enormous amount of money than any time before. And they're willing to pay, no offense to any VC, but they're willing to pay a crazy amount of valuation. So for us, the more deals we do right now, the more upside we're going to have down the road. So that's from the financial perspective. So we will double down. And we know the reality that half of them not going to make it. And we take it into account. From the evolution side, if you're looking at that, you're right, Sheila, that company that need to be able to pivot. So the question, are you a passive investor or an active investor? Some funds invest and they're pretty passive in that regard and they let the company do what they do. If you're an active investor, we want to double down the company staff with augmented with expertise that we have in our network, especially in our mobility space, to help them. So I think regardless to what the pandemic's going to look like and how we're going to recover from that, Jamie Dimon was talking in CNBC the other day, and he created a big squall in Wall Street because he said, guys, stop paying attention to the stock market. The stock market does not represent the economy. And Wall Street didn't want him to say it, but he said it anyhow. And then he said, look, Americans sitting on more cash than ever sitting before because they didn't spend money in the last 2 years. Debt ratio on the books for the bank went down dramatically. So the credit card debt that everybody said is going to be a problem is actually not a problem at all. People didn't spend anything. So the debt is very low. And he said, American consumer waiting for what's coming next. They have money to spend. The question, what they're going to spend it on. So you're right, there's accelerant in e-commerce, and we investing in a category which we create, or we stole it from somebody, I can't remember. It's called intelligent commerce. It's all the added value to the user experience on e-commerce. Any company can offer an edge. We had one company, we invested money and they pivoted almost magically in the right moment. They created a platform that IKEA is the biggest customer, the first big customer using them. You can go to the website and you can look for a product, but you have a question, you can click and then it transfers to your phone, and you can have a physical representative on the floor answer the phone with a camera, and it can walk you to the store and show you the product and whatever. And IKEA reported that that's increased their sale 25% in 8 months. So it's the question, we categorize companies as disruptors, originals, and copycats, right? Disruptors are too expensive and they require a lot of money, and it takes years to disrupt an industry if they'd be able to do it. Originals are the company that solving a problem faster, cheaper, better. They don't necessarily create the problem, but they solve it, and they agile to move quickly. The copycats is the one that say, hey, everybody else do delivery, we should do another delivery company. That's not a reason to start a business. So it's depending who you ask. I don't think even across the investment community, everybody gonna have the same answer, but we definitely gonna double down this year as much as we can.
Doran, you had, when earlier you mentioned that there are certain types of companies you are not investing in due to, COVID and the current economy. Are you willing to share what, just generally speaking, what those are?
Yeah, and it's not only because of COVID. I think it's some sectors become red ocean, and as an investor, you're always looking for the blue ocean, right? I was participating this morning. I'm originally from Tel Aviv. I grew up in Israel, in the ecosystem over there, and I was listening to the cybersecurity innovation authority in Israel at the conference this morning, and he said that he put on the board one. And then he put a Mark 750, and people said, what is it? And he said, according to our research in the last year, 1 out of every 750 cybersecurity startup actually making it. So it's such a red ocean right now, and it's a buzzword. Cybersecurity is everything. Yeah, but if you really look how many of them actually making it just to scale, very few. So and the VC chasing them with big checks. So there's no point for us to get there and be the small fish in a big pond. So that's one of them. We stay away from cryptocurrency just because I think until the regulator's going to decide how to handle it, I think it's unsafe to put money there. On an individual basis, I made some money on Bitcoin and stuff, but I would not recommend people to put their money there. That's one. I think the cannabis industry is someplace that's still unsure until it's federally legal. I don't think it's appropriate for us to put money. We don't do biotech and pharma because it takes a lot of money, and the regulating process can be much more scrutinized post-pandemic, they say to us, because of all of the stuff that went behind the scene of those vaccines. And then there's other sectors that become, we work very closely with Henry Ford Innovations office, which is here in the backyard in Michigan. I think although telehealth, telemedicine, remote patient monitoring, all this stuff, it's growing, it is extremely difficult to get a platform in that space to the healthcare system to actually buy into right now. And the reason is very simple. Lisa, she's running the innovation therapy, said to us, we're going to be in the red for at least another 2.5 years to recover from COVID. So although we're going to tell you publicly that we need all this technology, we're not going to spend a dime on it until we get in the black. So a lot of telehealth companies and digital health and med tech company that are going after the healthcare systems. We're not going to invest in right now because I don't believe they're going to get the traction they're looking for. And it's a patient-driven decision, not healthcare prices. If the patient doesn't like the platform, they're not going to use it. So those companies need to pivot and start focusing on the patient, not on the healthcare. The healthcare does not have any money to spend right now. She said, I can give you the shopping list of what we need right now. The boards were not going to allow us to spend a dime until we're in the black. And all those hospitals will have to get out of, or the healthcare system will get out of the black in another 2 years, 2.5 years. So anything to do with services to current retailers, it's in a question mark right now, because I don't know if you see, what they say in crisis, the rich get richer, the poor get poorer. So we say the Amazons get bigger and the retail disappears. I think if you go to Kohl's, if you go to Walmart, if you go to any of the big retailers, the store getting smaller and smaller because they just don't need the month's merchandising anymore. So all this supply chain around the retail system right now is in a question mark for us. Because you're going to need less and less of it. And eventually Amazon's going to deliver all the product to the retailers as well. So it's kind of funny, right? So that's kind of our take on it.
Thank you for that. With, given the economy, given the volatility, the inflation, the labor trends that, Jennifer, you were talking about, I guess my question is, how are your term sheets and let's say kind of like the more legal aspects of your investments changing? Have they changed at all? And if so, in what way?
Yeah, it's a good question. And I'll maybe would be the same for generally everyone in the private markets. So the firm, I know I did a quick intro earlier around the firm, but we've been around for 35 years. We've been actually fairly disciplined in that kind of growth stage businesses. And when we say growth equity, we actually look at the company's revenue thresholds, among other things, to determine that growth stage. So really companies who've proven their traction, unit economics to a certain degree, all the way to how do we see this, where does this go, what's the market size, the typical things that come in, and the team who can scale all this, right? So that's been our bread and butter. And kind of coming from that perspective, we've always been fairly disciplined in terms of how we think about both initial investments as well as what that would be. I don't want to say regardless of what's going on in macro, you not only have to know, but be aware and how that impacts in different things. But specifically to your question around legal aspects of term sheets, I wouldn't say, and then again, I'm caveating it and generalizing it, right? But if you have to, I guess, make significant changes, I don't really know what that means for what you were doing in the last couple of years, if that makes sense, right?
It does, yeah.
Fundamentally, if you right, because again, going back to my earlier comment around what are the investors looking for, regardless of how early or how later stage or whatever it may be, right? When you're looking for fundamental things and when you're looking for that long-term mentality and all these different things, really legally, should it change significantly between one day to next, right? Again, maybe I'm just not interpreting the question correctly, but it's
No, I hear you. And by the way, just a time check, we have about 5 to 7 minutes left on the panel. So I'm gonna try to fly through some other questions. But if anyone else has an answer to this particular question, is have terms in your term sheets changed at all because of the current economy? Would love to hear your thoughts. But I understood exactly what you said, Jennifer.
I don't know if the term sheet specifically changed. I think maybe the mindset shift a little bit. For example, we initially, when we started the group, we decided not to invest in safe notes. And then, we did here and there, we did a couple of safe notes. And this year we decided no more safe notes. And the reason being is that, especially in an unstable economy and maybe the risk that some more company going to fail, safe doesn't give me the opportunity to clear up some of my losses as a convertible note. We do a lot more convertible note than equity around a company that we have some question mark about their ability to scale. which is easy to do. We forcing company to initial investment on preferred stock versus common stock. We basically don't do common stock at all almost. If it's not preferred stock, we don't want to do it. And then so I don't think it's the legal change. It's just or warrants or pro rata rights, things that is very important for us to maintain. That maybe in the past we didn't be that diligent to keep, but right now we are. Make sure we don't step over it. To answer your question.
Very, very cool. Shaila, I see you nodding your head.
So yeah, I was going to say the same thing. So not so much the legal part of it, but like for us, we had to increase our valuation limit. We weren't going to go over a $10 million valuation, and now that's almost a laugh in the face for some of these companies. So we had to increase our valuation, the valuation that we would invest in companies. We are making sure we have pro rata rights. So especially for those, we have a company right now, she's going through a bridge round, and we're like, well, wait a minute, are we going to have pro rata in this particular round? It's being led by a very on-brand firm, and we want to be a part of that. And so those are some of the things that we've been looking at. And is Doran's points, we're saying no to things like safe notes. Like I'm like wondering, why did we do it in the beginning? And we only have one. And so I think what has happened is that we just look at this whole deal process a whole lot, and we're active investors for your just for your knowledge, Doran. And so we're looking at this as long-term relationships with these entrepreneurs. It's not just here's some capital and talk to us in 2 years. We want to stay involved. And so we're really looking at our deals a whole lot closer. And yes, we know we'll have some that'll fail, but we're looking for some winners.
Very interesting.
Yeah, the one thing that's to add that we actually made mandatory almost in every investment we made starting in November of last year. We wanted, at the very least, we want to have an observer right on the board, if not a board seat. We want to hear what's happening in the company, not from the CEO or the founder itself. We want to hear from everybody sitting around the table.
And I'd love to hear from you, Daniel, as our resident attorney on the panel. Is there anything super interesting that you're doing in terms of either new terms and term sheets or greater focus on previous things that were dismissed in the past?
Yeah, it's interesting. I think consistent with others, it's not so much drafting terms differently. Certainly, we have been even kind of more anemic than we ever previously were to kind of uncapped notes. And I think interestingly, we are, I think because of the dynamics of where, in my view, COVID has accelerated kind of winners winning. It has certainly meant that there's stronger interests by certain investors in doing things like special purpose vehicles in order to scale companies much more quickly. So that is something that we have certainly seen. But nothing has kind of uniquely led us to want to kind of renegotiate typical standard terms in the term sheets.
Okay, very cool. Shaila, I'd like to point a question at you. You mentioned your bridge rounds for your portfolio companies. How are your portfolios? So that was an interesting kind of narrative there. But are there any other ways that your portfolio companies are extending their runways in this economy? And if so, how are they doing it? Are they is there anything non-traditional that they're doing that would kind of help? A lot of our attendees here are startups and founders, so would love to hear your thoughts.
So first of all, we have a follow-on funding for the companies we invest in as part of our strategy. We want to be there when they begin to scale. So these bridge rounds don't scare us. We understand that this is what we signed up for. And so what I've seen companies, this one in particular, she's raising $3 million right now. It sounds like a real full round, but it's a bridge round because of customer demand. So I'm seeing some of that. I'm seeing people go back to the market early. I have one of my companies, we just made the investment maybe 6 months ago, and she's back in the market, mainly because of an investor's desire to lead a new round for her. And I'm going, but based on what? What have you done that sort of requires a new round? But this investor is highly interested in her product, and she's signed on with Salesforce, and things could escalate pretty quickly. And so I'm seeing those type of things. Some of my entrepreneurs are going out back to the market earlier. If you can't get VC capital, which is what we are, there are things like revenue-based investing. There are low-cost loans that a lot of communities are wanting to put into hands, especially of underrepresented founders. That's happening right now. So seeking out those types of, I always tell people, look for as much free money as you can before you start even talking to someone like me. Get as much of that money through grants or other types of sources before you look at venture capital, because we're looking for you to scale quickly. But when you have a growth in between a round, most of these folks are just doing a bridge round, getting someone, typically a new investor or one of the investors who are in the past round, to lead it for them. And just because of this founder's tenacity, she's been able to do it, and doing extremely well. And we did come on as a follow-on fund, and we'll do it in her next round as well. But I think it's on the entrepreneur to become very creative about finding, capital resources in between, rounds. We say when you raise for 12 to 18 months of runway. And so sometimes, you're going to have to change a few things on your roadmap if you don't have that capital, before you start asking more investors to come in again. Dorian, you're going to say something regarding that? You stood up.
No, I mean, I agree with you.
Okay.
Yeah, I actually can share something here. So at Diagnos, we've been funded primarily through SBIRs. So we have a little bit of VC money, but the SBIR program, which is the Small Business Innovation Research Program, is what we landed, and it's been great for us.
We even those are great opportunities. We did an entire session with NASA this fall, talking about how folks can get grants. People think they have to have a space, they're building a rocket or something. It's like, no, NASA's not only looking for rockets, they have other things that they need internally as well. And so finding those and these grants are like a couple $100,000. I mean, some of them could be, and some of them are millions. It can be significant.
Absolutely.
So I'll just comment quickly.
Okay, go for it,
tying
Daniel.
this back to both the inflation conversation and then what I think you're seeing with CBER funding, throughout lots of the executive branch, which is, one theory of, causes of inflation is regulatory uncertainty. And, I think there's validity to that in the short run. Certainly under President Ford, the idea was that if you could actually deregulate, you would kind of solve the inflation problem. I think what's a potential phenomenon that's happening right now is you have the government actually getting into a space that traditionally private capital was in. And I think that is leading to the uncertainty, which to say, if I'm getting non-dilutive financing through government grants or government, cooperative agreements, to what extent does that de-risk me from a regulatory perspective? And I think as we see the executive branch take a larger role in becoming a VC, there has to also be clarity about, what does this mean from a public policy perspective?
And I just received the notification that the panel is over, but I'm gonna use my position here as moderator just to follow up with one question for you, Daniel. Is that a good thing, or do you view that as a good thing or bad thing for the startups to have more opportunity to get this non-dilutive capital? In other words, you looking at a company that did receive a CBER, is it like, wow, these guys or ladies received all this cash, this is like, free upside for me as a VC, or is it create that uncertainty that makes you kind of waver in whether or not this is a good deal?
Yeah, so it's a hard question to answer. Here's what I can certainly say from experience is, in what I think is an unintended consequence, is if you are a company that gets denied CBER funding or back 10 years ago, it was the loan guarantee program at the Department of Energy. And if you get denied, or it immediately leads to a reaction where VCs tend not to want to bet on you. And I think that is certainly a problem, and certainly something that happens when the federal government decides to become capital investor in chief versus saying, let's let the markets do it.
Okay, great. Well, thank you everybody for sharing your thoughts and comments. It's definitely an interesting time that we're all living through, and I know at least from my position as a founder, I've learned a ton from this conversation. So I'm pretty sure there's been a lot of knowledge that everyone that's attended has benefited from. So thank you very much.